We've been talking this morning about how earnings expectations have been coming down pretty drastically. 7.8% is now the expected number for the S&P 500. That's down from 10.1% just about 3 months ago. So what happens? Have these expectations come down far enough?
I think they've come down pretty far. We're looking at about 9% for the year. We overestimated. We were up into the mid-teens if you go back to June and so looking towards 2019. The realization is that the tax cuts are built in right now. How much organic growth are we getting from here? And we got a little bit ahead of ourselves. The big question is going to be, will the street be satisfied with a high single-digit number, whether it be the 9% or the 7.6 that you're quoting on here? The PE's forward, not bad, 14.6 for 2019, which is a tick less than the historical numbers. So the earnings, hopefully, a week from Monday starts the big banks. We get down to them in the guidance, and the question is, does the street accept single digits after the 20% plus, which was mostly tax-inspired?
Josh, a lot of this comes down to what the economy looks like. Yep. Based on what you see from leading economic indicators, what do you think we're headed into?
Well, we've got a divergence here between the economic data, which the preponderance of which suggests the economy is doing well and the fundamentals still sound, and the markets, which are sending a much less upbeat message. And I think until we get some resolution of that conflict, the Fed, for example, is going to be, watching to see how that plays out. Markets are an important signal and also contributor to the economic outlook, but they're not the only ones.
Yeah, what about if you look at housing or other weak indicators that we've seen?
Sure, we've seen some weak ones. Housing is an area that both being affected by the tax situation and a little bit earlier in the year by higher interest rates. But now interest rates have come down a little bit, and other fundamentals for housing still look okay. The consumer labor market still looks strong. The private sector doesn't seem over its skis the way it was heading into the last couple of downturns. So I think the fundamentals are still good, but I do think growth's going to be a little bit weaker. I don't think it was on a sustainable trajectory. Unemployment rate cannot continue to fall indefinitely, so that's going to be an important contributor.
I got to make one very quick point, which is 9% is fantastic.
Sure, earnings growth, although you were talking about
let's put that in economic context, right? You do 3% real, 2% inflation, 5% underlying growth, let's say, for example. You're talking about 4 percentage points on top of underlying growth, which means increasing.
That does not mean that the market's going to reward it, because we were looking at 24% growth this past year, and you saw what stock.
I know. I'm just saying that if you get 9% growth, you should be laughing all the way to the bank on that.
The other piece of it is the markets are much more sensitive to the global growth picture versus U.S. economic growth, right?
True.
That's where earnings come from.
Concerns are rife there. A lot of uncertainty about what's going on in China. It's a black box. The trade negotiations, how that plays out, clearly weighing on the market. So if we could get some resolution there, I think that'd be a big positive.